What has been going on in the world the last several years? We've seen soaring energy prices and soaring food prices batter an already beleaguered economy. This unsettling upward surge of prices in the energy and food markets raises the question, who and what has been responsible for this? Hello, my name is bsdungan, and today I'll explain how institutional investors have wreaked havoc on the world's commodities markets. First, we will discuss how institutional investors drove the price of oil to record highs by creating an artificial shortage through their practice of index investing. Second, we will examine how their investment strategies also caused the price of food and other essential commodities to rise. Question?
What are institutional investors?
Institutional investors are pension funds, university endowments, investment banks, and other such large market players with large sums of money to invest. Another question?
What is index investing?
Index investing is the investment of capital by institutional investors in commodity futures contracts that contain an index of several commodities that are traded on the futures market, with oil futures making up the largest portion of these contracts. It's important to note that index investments are made with the speculation that the price of the commodities in these contracts will rise. Does that help explain some of these key terms? Yes? Any more questions? No? Then let us continue. Until recently, institutional investors didn't trade in commodities because they were considered too risky. But this all changed between 2000 and 2002 when the real estate markets and equity markets that they had been trading in became extremely volatile. At this point, these large institutions were advised by their financial consultants to start index investing in commodities futures contracts, specifically futures contracts that were heavy in oil. And this they did. Between the end of 2003 and March 2008, index investments in commodities markets went from $13 billion to a staggering $260 billion. But these institutional investors didn't buy and sell oil like the traditional investors in these markets did. They bought and held their oil contracts much as they had previously done with stocks and bonds. They stockpiled oil with no intention of ever selling it, speculating that the price would rise and that the value of their holdings would increase over time. Michael Masters, a successful hedge fund investor, testified before the Senate in May that institutional investors had stockpiled over 1 billion barrels of oil. Question?
Isn't there some kind of limit on how much oil they can buy and hold?
No, recent legislation was passed that exempted them from any limits. So because of this, they were able to employ a hoarding strategy that effectively created an artificial shortage of oil on the market that drove the prices up. A U.S. Senate staff report from 2006 entitled "The Role of Market Speculation in Rising Gas and Oil Prices" states, quote, "There is substantial evidence that the large amount of speculation in the current market has significantly increased oil prices," end quote. Now let us examine how their investment strategies also cause the price of food and other commodities to rise. As we discussed earlier, when index investors purchase commodities futures contracts, they're primarily purchasing oil. But there are also other commodities such as wheat, corn, and cotton that are included in these contracts as well. Now keep in mind they're not selling any of these contracts, so not only are they stockpiling oil, but they're also stockpiling other essential commodities as well. Michael Masters also testified before the Senate in May that index investors had stockpiled enough wheat to, quote, "supply every American citizen with all the bread, pasta, and baked goods they can eat for the next 2 years. Rod Clark, a grain services manager who represents the National Grain and Feed Association, explained it to a House subcommittee like this. He said, quote, "These passively managed long-only contracts are not for sale at any price for extended periods of time, resulting in elevated prices not reflective of demand, increased speculative interest in the market, increased volatility, and pressure on banking resources to fund margins," end quote. So basically it works like this. The higher prices go, the more money index investors want to put in the market. The more money they invest makes less and less of the commodities they're investing in available on the market to consumers, and this in turn drives prices up. Let's take a look at the graph that Mr. Master used in his testimony before the Senate in May, as this illustrates this for us very nicely. We see that the black line running from left to right on the graph represents the spot price of the commodities index. Previous to the year 2000, index investors had relatively no investments in these markets, and the price of commodities remained relatively stable. But from the year 2000 to the end of 2008, when institutional investors increased the amount of money in their index investments from $13 billion to $260 billion, there was a drastic increase in the price of commodities that was directly related to how much money these index investors had in playing these markets. So in summation, the evidence clearly shows that institutional investors have had a definite negative impact on the world's commodities markets the last several years. As House Agricultural Committee Colin Peterson said, quote, "The smart guys who were in the subprime real estate market sold short and saw the best opportunity in the commodities market. They ran this thing up, and I think the prices are artificial," end quote. By hoarding large quantities of oil, institutional investors created an artificial shortage of oil on the market that drove prices up. It is also clear that their investment strategies had a similar negative impact on food prices as well. These volatile issues beg the question, what can be done to mitigate these crises? Well, the short answer is that more government oversight of these investors' activities is obviously needed. It's hard to argue with consumer advocate Mark Cooper when he says that it is time for those in government to, quote, "roll up your sleeves, assert the national authority of the United States, and regulate these markets," end quote. But, as we are now out of time, that will have to remain a topic of debate for another day. Thank you for joining me today.